Hello, and welcome to Livewire's Buy, Hold, Sell. I'm Hunsley, and today we'll be reviewing the year that was 2024. What were the big themes? The hot stocks. And we'll also be exploring what investors need to be doing to be successful in 2025, as well as a couple of stock picks to help you on your way. To do that, we are joined by Henry Jennings of Marcus Today and Hugh from Atlas Funds Management. Happy holidays to you both. Thanks for joining us for the last one.
Thank you.
Let's dive right in, shall we? Henry, in one word, how would you describe 2024?
Concentrated.
Right.
I think that sums it up for me. I think when you look at what's happened in the US with the Nvidia and the FANGs and the whole the behemoths there, and then you look at our market and you see that the effect the banks have had in our market, it's been a very concentrated market. It is just starting to broaden out somewhat. We've seen that in the last few months, I guess. So that is a good thing because a lot of funds were in those particular stocks, which can be problematic.
I read a chart title not too long ago. It's like the world's equity markets are essentially leveraged to Nvidia. So if it messes up, we're all in trouble.
Yeah.
Hugh, what word would you use to describe 2024?
Surprisingly buoyant. I remember sitting here this time last year, things were looking a bit grim, where the banks were facing perhaps a lot of loan losses, which is why they've done very well. There was a lot of bad economic news out, a lot to be afraid of. And the markets have sort of climbed this sort of wall of worry, and we're up close to 22%. Would never have expected that to be this, but I recognise Henry's point, it's quite concentrated. If you didn't own the right stocks, you've had a tough year.
Let's shift gears and we'll talk about investments. Hugh, I'll stay with you. I'm curious, could you tell us about a company you wish you backed during the year, and what is one that you wish you didn't?
The key one I wished I'd backed was ResMed. Sitting here last year, the stock price has gone from sort of 36 to it's about $22. Due to the impact, not of earnings or down sales, but just the fear of those GLP-1 drugs and Wegovy. There's a lot of big clouds on the horizon. We didn't really know what that was going to do to sales of sleep apnea devices. Philips, who's been out of the sleep apnea market for a while, we're going to come in the new year. And then the new Mounjaro drug from Eli Lilly was supposed to make things even worse. And there's just a lot of fears. And so for sitting here, it was probably the stock, a very high quality stock that was on sale. But for us, it was all very binary outcomes, which I didn't really know the answers. So I wish we'd own ResMed and pulled the trigger. It was a very popular stock for a lot of fund managers, but just because we couldn't really quantify those risks, we did not buy the stock. Yeah,
absolutely. So that's ResMed. And what's one that you wish you backed, or you wish you didn't back?
Every fund manager has several of these in their portfolio, and any fund manager that tells you they don't are lying to you, or they're Bernie Madoff. The one I wish we didn't have in the portfolio was Mineral Resources.
Yeah.
So it's just had a really tough year. They've falling lithium prices, negative sentiment generally to the miners. We're seeing that across the sector. Building two big mines, which has created a little bit of a debt issue, and then the big wild card there, the activities of the historic activities, governance issues from the very charismatic and well-regarded CEO Chris Ellison, and that's just been a drip feed of information, which is, while it's been tough in that lithium sector, it's a quality stock, but that drip feed of information has just seen massive sort of deratings and just a bit of outlook. So sitting at the start of the year, I wish that was not in the portfolio.
You and probably a few others. Henry, what about you? What are you happy that you backed, and what would you prefer to forego with the benefit of hindsight?
Well, I'm happy that I backed Zip. It was my pick for 2024 last Christmas for another media outlet, which I had to do. So I'm pretty happy with that. We pushed it pretty hard in the newsletter as well. I guess the downside of that is that I saw it going from 40 cents to $1. It's now $3.50. So I did suggest taking some profits, in all honesty, at around $1 because we've done pretty well out of it. But not taking all the profits, having said that, and it has done extraordinarily well this year for a combination of factors. And I guess it was interesting. They did a capital raise, which actually raised more money in the capital raise than it was capitalized at last Christmas. Go figure. It's a $3.5–4 billion company now. We even saw the founder, Larry Diamond, pull the trigger and resign and move back into doing philanthropic stuff, and the stock hardly rippled. He sold shares as well, and it hardly moved, which I guess is testament to the business model that we're seeing in the US and the strength of the US market and the US consumer as well, and the lack of bad debts, which Hugh was talking about in terms of banks. It's similarly in buy now, pay later as well.
Yeah.
I guess, and the ones that I shouldn't have backed have been primarily resource-based. Resources has been kind of tricky this year, to say the least. Uranium it's been very cyclical, and you've got to be quite quick on your feet. I think, I've been probably too wedded to some of those ideas, the likes of Paladin, Boss, Deep Yellow, even the big one, BHP, has been problematic this year, I have to say.
Yeah, no, absolutely. Henry, I want to stay with you to ask you a more general question. Yeah. What do you think investors need to get right in 2025 in order to be successful?
It's going to be stock picking, I think, more so than maybe 2024. What is going to be interesting, I think, from a global perspective, and maybe it's not even a global perspective, and maybe it's just a US perspective, is how the big guys monetize AI, because we've seen a huge spend in terms of gearing up with chips and the whole AI from the big four, from NVIDIA, which has done NVIDIA really well, but we're yet to see really how they monetize that. And now they've sort of done the land and expand. It's very hard for anybody else to get in there. So it's now what apps come from it, what the platforms drive in terms of revenue. So I think that's going to be interesting. But I think 2025 is going to be back again to stock picking. I don't think we're going to get a repeat maybe of 2024 with the banks. I don't think we're going to get such a repeat of what I call the plastics. Some people may remember Mean Girls back from 2004. and the plastics were the really popular school kids. They were the popular ones at school. Could do no wrong, but underneath there was a small, there was a bit of a niggle. They were a bit cruel, a bit nasty. And we've had our own plastics, and we've had very, very popular stocks that have gone absolutely nuts this year to extreme valuations. And you've just got to be careful, I think, with those that we don't see a little bit of a slip, and they will get punished, as the plastics did.
Tina Fey, creator of Mean Girls, if you're watching this, I'm a big fan. Hugh, portfolio construction, theme management, usually a good key to a healthy return. What do you think investors need to be getting right next year?
It's the same as every year. As an institutional fund manager, getting your banks versus resources call right. Yep. They're both about 25% of the index, and if you got that tilt wrong, you often have a good stock picking year, but that negates it. If you'd followed what a lot of the sell side were arguing to in sort of February and March, sell all the banks, go nude in the major banks, you're a fund manager, you're probably looking for a new job right now. You've been fired. So getting that call right, and then as following Henry, the banks have had a great year. There's been a massive PE expansion, particularly in the largest bank, CBA, trading at 22, 23 times versus a long-term historic of 16. Getting that call right. I think that's as always it is. And if you've got that wrong, it's going to be a hard year.
All right, thanks for that. All right, time for what you all came for, what you always come here for on this show, and that's some stock picks. Hugh, I'll come to you first. What is one stock you would bet the house on over the year ahead?
Okay, well, this is a pretty boring pick, but I was doing this. If I had to buy a stock today, not be able to trade it for the rest of the year, and then try and crystallize it at the end of the year, and concerned about what nasty macro stuff is going to go, it's got to be CSL. Very boring. It's been left behind a bit in the rally this year. There's a bit of concern about vaccines. RFK Jr., as the new head of health in the US, he's concerned about vaccines. 17% of CSL is from flu vaccines, and he was obviously very concerned about the COVID vaccines. But the flu vaccines, they work. They've been around a long. I take mine every year. I avoided a flu this year, and so that's been a bit weighing on it. But looking ahead, they've already guided at the most recent at the AGM for a 10-12% earnings per share growth. Bad things happen in the US, bad things happen globally. A lot of the stuff they sell is non-discretionary, which you need to live. Some of the immune biotherapies, they're still going to be around. It's had a bit of a weak year. I'd be happy to own that if I couldn't trade it for the rest of the year.
Yeah, absolutely. And I mean, boring as it may seem, CSL has consistently been the #1 pick from Livewire readers in our annual survey, which is also a good reminder for anybody who hasn't filled out that survey yet. You can access that via the website. You're welcome. Henry, what about you? What stock would you bet the house on next year?
Well, it is a bit of a cyclical stock. It is Newmont, which has had,
not a Goldie.
It is a Goldie. There's a lot of people that are still pretty bullish about gold going forward, and we know. I think that under Donald Trump, things could get interesting, to say the least. We could see a little bit more volatility. And Newmont, for me, it's had a bit of a production downgrade recently. The stock got whacked on the back of that, so that's a good thing because at least you're buying it at a lower base. And what appeals to me is it's a company going through it's a bit of a Humpty Dumpty stock because it's, they put it back together again. Obviously the Newcrest deal has changed it. They've sold off a lot of assets. There's a lot of surgery going on with this stock at the moment. I think they've sold over $3 billion worth of gold projects. They've got a couple more to go. And I think, that's going to put a pretty good balance sheet in place. We could see some capital management initiatives. And I think the gold prices, it may not be as stellar as it has been this year, but I can see it, having its moments. And I think the gold miners have been left behind. And this, I think, with Newmont is an interesting opportunity on the back of that slight production downgrade to get in at kind of, not the rock bottom, but to get in at a level which is reasonable compared to where I think gold could be at the end of the year.
They were punished pretty hard on that downgrade.
They were punished pretty hard. And they did a really good deal the other day with a couple of projects they sold. They've got a couple more to go. And that's going to give them a pretty good balance sheet. And then the surgery's done. And that's, I think they're going to raise close to $4 billion, which is double what they said they were going to do in terms of sales at the beginning of the year. And they've all been done at pretty attractive prices. So the only thing missing, I guess, is a bit of sentiment. And I think it'll take a while for that to pan out, if you pardon the gold pun somewhat. But I think, at these kind of prices, it looks quite attractive.
All right. Well, to round things out, we've also asked the gents to bring along one stock they would avoid next year. Henry, what are you avoiding?
Well, this was a 50-50 coin toss, I have to say, in terms of whether it would be my stock pick for the year or one to avoid, because it is it feels like a binary outcome, and it's Star Entertainment.
Aha.
And it does feel like a binary outcome. Here we are at sort of 20, 22, 23 cents, whatever it is, and it's got serious problems. It's been able to draw down the first $100 million of its debt package, but the underlying problems in terms of patronage, in terms of profitability, they are still there. In terms of the high rollers coming, they are still there. So for me, it is in the too hard basket. But if you wanted to have a massive flyer, you could easily see this at 35 cents again, or you could easily see this at 10.
Or zero.
Or zero.
The lenders have taken control of it.
Or lenders are taking control. But, who in your right mind will want to take control over a casino that has got those kind of problems? You'd do anything, wouldn't you, to keep it out of your own hands? NAB doesn't want to run the thing.
That's a governance story, I reckon, that's going to be written about in Harvard Business Review before too long.
Already, probably.
It probably will already be written. Hugh, we'll finish up with you. What's one stock you are avoiding next year?
Not quite as exciting as Henry's pick.
You're not on the roulette table?
No. I mean, they have 2 capital raisings last year, one of which to pay a fine.
Wow,
yeah.
Remarkable.
Yeah, and the lenders are losing patience. I mean, for us, probably a bit of a more high-profile stock. I look at Ramsay Health. This company is under a lot of pressure. It's a very low-margin business, a lot of debt on the books. Yeah. We're seeing in the press today they're clamoring for private health patients to pay extra money. But also looking at it a bit further, we've got higher wage costs, the nurses are going strike, and further, like we're seeing the private health insurers, the likes of Medibank Private, are doing more in-home patient care. So rehab care, instead of paying $2,000 or $3,000 to Ramsay to sit in a hospital, you sit at home, they have a nurse comes and visits you. Very popular with the patients, very popular with shareholders. The sell side have got it on 30-odd times earnings. They've got a 50% increase in the consensus numbers over the next 2 years with massive expansions in margin. So much capacity for that to go backwards. There's a lot of pressure. I think there's a lot of capacity for disappointment. I'd be giving that a wide berth. The winds of change are going against it. It's still viewed as a premium stock. Once upon a time it was trading at $70, $80, but I think those times and those large amount of growth is gone.
Yeah, absolutely. Well, that is all we have time for today. If you enjoyed that episode of Buy, Hold, Sell, why don't you give it a like? You can subscribe to our YouTube channel and the Livewire Markets website where we are adding lots of fantastic content all the time. Till we see you next, take care.